Okay. Yeah, so just feel free to fire off your questions, anything that you have as we go along. Um, all right, so you got your basic, your basics. This is your basic platform. What you're going to see as soon as you open it up. I'm going to pull this away because you're not going to have this. Um, you're not going to have this when you first open it up. So we'll just take this away. So this is what it'll look like. Sorry. Okay, so you'll have your basic platform. First question is asking about the volume profile, and that obviously is one of the most important ones because of what it is and what it does. So let's do a little quick explanation of what that is. So when you have regular volume bars right here at the bottom, which I'm sure you're all familiar with at this point, so this is volume by time. Okay, this is volume by time. So it's going to give you the volume that's within that certain time period. So like right now we're on a 20-day 1 hour. So each one of these bars is going to represent the total volume that's executed within that 1 hour time block. So let's set up the volume profile. And so how you're going to do that, you're going to go up here to studies, this little bottle here. Hop in here to the side on what studies you're looking for. You'll type in volume profile, click that to highlight it, add selected, so you'll want to add it to the price right there. Click apply, you can save it. We can't see diag boxes. What do you mean? Oh, dialog boxes. What do you mean dialog boxes? What is that? Oh, you can't see the pop-up. Got it. Got it. Okay. All right. Thanks for letting me know because yeah, I got you. Okay. All right. That's fine. So that will show up in the recording, but thanks for telling me. So if you're, I am screen sharing right now. So yeah. So that's interesting. It's not. I don't know why it's not showing. I guess because it's like a pop-up, so it's a screen on top of a screen. Yeah, so it's not showing. It's showing for me, but it's not showing for you. I think because it's a pop-up, so most likely the screen share is reading it as a separate screen. Yeah, like Shaq said, yeah, it's a layering issue. Okay, so what you'll do is go up here in this blue box. Okay, you'll go up here in this blue box and you'll go to this little flask. It's right here. It looks like a little chemistry flask, if you will. Okay, you'll click that. You'll click this button here, and then you'll get a pop-up, and it'll look like this. I'll screenshot it in the chat so you can see it. You'll get a pop-up. Looks like that. That's what's on my screen right now. Okay. Then what you'll do is you'll type in volume profile. Again, this will be in the recording, guys, so don't stress it too much that you can't see it. So you'll type in volume profile like so, like that. And in the left, click it, and then at the bottom you'll go add selected. That bottom left corner, you'll click add selected, and you'll add it to the price. Okay, so then obviously it'll look like this. You'll have your volume profile as your only study in there, and it'll look like that. So you'll add the volume profile to the price, click the apply button, and then you'll save as a set, right? You'll hit that little save as button down there at the bottom right. So you'll save that, and then that'll put the volume profile on your chart. Okay. So what is the volume profile? So like I said, this is volume by time, right? For time block. This is volume by price. Okay. So volume by time, volume by price. Why is volume by price important? Because volume by price is important because the way that BFI trade, they trade across larger time frames. They typically don't execute their entire order at once. So as you notice, you have this large large profile here because there was across this 20-day time period, which is what we're looking at right now, the majority of the volume was exchanged within this range here, right? So from 558 to 562. And the reason is because of all this distribution that took place here before this markdown, and they grabbed that liquidity there at the bottom. So across 20 days, the majority of liquidity was exchanged here. So that's literally all you're looking at. You're just trying to figure out where they are trading, okay? Where they're trading the most. And the reason for that is because the way that the price moves away from this volume that's what's called a point of control. The way price moves away from this point of control is typically going to tell you what's going to happen next, okay? So like when we were trading over here, for example, and this was a couple weeks ago, and I was telling everybody, hey, we need to go short here. One, I'm reading the price action, but two, I'm also seeing this massive volume profile, which was pinned at about 560-ish or so, anticipating that price would move south away from that point of control. So imagine that this right here was sitting at this point while we were trading here. So obviously we had that large markdown. But then when we move along and we move forward in time, right? So right now we're looking at the whole period, but let's say we just wanted to look at these last, this leg, if you will. So maybe I'll adjust my time, right? And we'll look at, say, the last, let's see if we can get that down here, say the last 10 days, right? So bring the time frame down. Where is the most amount of volume being exchanged, right? Okay, so we had a lot of action take place here at this 551 mark. So like, how can we use that to our advantage, right? We'll look at the 10-day, we'll look at the 5-day, right, which is 1 week, right? And we can see we had one down here, right? Now it's moved up here. There was a ton of volume exchange there on Friday, but you can see you had all this liquidity down here that was accumulated before they did this markup, right? So again, we're just trying to figure out where BFI are trading, where they're trading, and what based on the price action, what we're seeing on the chart, we can make decisions on whether or not that price is going to move above or below that point of control at that time to decide on, okay, well, if it's moving away, let's say I had this point of control here at 546, okay, if it's moving south away from it, possibly it will have a continuation south, right? But if it moves back above it, then I'll say, okay, well, maybe I need to flip positions and I need to go long. I need to start looking for long positions. So like, for example, on Friday, right, we went long on Friday, right? Because I'm assuming that this large amount of volume here, they were stacking a position. Now, again, you're using that profile just to understand where they're trading. How you read the price action that's going to determine, okay, whether I want to go long or short, right? So like, let's just go back real quick. Like when we were over here, right, when I'm reading the price action, keep in mind I had a volume or a point of control sitting here in the middle. Okay, so let me put a line there, just for visuals, right? Get a line going there, right? So let's say I had a line like so in the middle, right? And I'm reading this price action, and in my mind, like when I have this point of control sitting in the middle, and I'm like, okay, well, what's happening? It's like, all right, they sold it there, they sold it there, they sold it there. You know what? All right, maybe I need to start looking short because I have all these equal highs and every single rally gets stomped out, right? So that's, just I'm summarizing my thoughts here. I obviously had other points of confluence, but I'm using the price action in conjunction with the volume profile. It's not to say that just because you have a point of control sitting here, that doesn't mean that it's going to go short or it's going to go long. That's your job as a trader to be able to decipher and read the price action and say, okay, yeah, Like when I said it was on the 27th, so that was here, we started literally going short right here on this candle, right? That was when we took our first short position. And the way I was reading that price action, I was like, okay, yeah, this makes sense to go short, anticipating that price to move away to the south side and mark down, right? But vice versa down here, right, where I was looking for that continuation short, right? I was looking for the continuation, and we cashed out our shorts down here at the bottom, and it never got that push through. So after we cashed out, I just kind of waited, and I waited to see what was going to happen. And then when it finally pushed up away, I was like, all right, you know what? Maybe I need to start looking for a long position. So Thursday we kind of went back and forth, and then Friday we were going long because I saw it pushing in the morning. Again, using that volume profile, let's say if we were looking at this across just 48 hours, right? Let's get this going a little bit better here. Make this look a little cleaner. Let's go 2 days. Okay, so like before this price moved up away, my original point of control was here, and then I had one here, right? So essentially all I'm doing is I'm chasing that point of control, and I'm making decisions on which way I think it's gonna trade based on the price action, option flow, etc., and what's happening at that time. So when I had a point of control here, right? When I had this down here, it's like, okay, well, it's not breaking above, so I went short there, I went short there, I went short there. You know, the last one failed, right? But then we had another one that developed here at the 559 mark. I'm like, all right, well, they're shoving this thing long. And I said to myself next day, I was like, all right, well, if it pushes above this 559 point of control, I'm going to go long, right? So we had these lows here in the pre-market. So when the market opened, I said, hey, guys, we go back and retest these lows, go long. Go long off Asian London session, right? So now we have another one. We have another one here. So on Monday, I'll be doing the same thing. I'm like, okay, well, if it holds this baseline, right? If it holds that baseline and it doesn't fail underneath it, maybe start scaling into a long position, anticipating this top to break, right? Or in the morning, if it gaps down and comes back to this 559 level, I'll see if they protect it, see if it bases there. If I get a structure, like one of our 4 structures, I get like a drop base rally, right? Then I'll say, okay, well, if it holds this base, then I'll start scaling in long, right? Just as like a general idea here. But that's how I'm using these point of controls, because I want to trade where they're trading. I don't necessarily, for what I'm teaching you guys and what we predominantly use for swing trading, when you're trying to time the market, okay, timing the market is very, very difficult, and I reserve that only for intraday movements, right? So like when you guys are day trading with me, I'm not only trying to be directionally correct, but I'm also on time as well, right? But once you have an understanding of where the BFI are trading, you don't necessarily have to time it perfectly, okay? That's the whole key to this. That's what this tool does for you. And that all you're trying to figure out is where they're trading. If you have an understanding of where they're trading, you have option flow in your favor, you have the correct structure, right? You have maybe a drop base setting up, maybe then you get a rally, right? Or in this situation, you have a rally and then a base. You know, maybe you get a drop because there's a lot of liquidity there. But then if the price pushes up above, it's like, okay, maybe this is a rally base rally, right? That's one of our setups. And if it's pushing above that, then I can expect, okay, maybe it's going to go all-time high, right? So that way, you're not necessarily trying to be on time perfectly, because it's going to be difficult for you as an amateur trader, right? So like, let's go back to this one. We weren't necessarily on time for this short trade. We did a short from here, sold here, then we started another one over here, and then we cashed out here at the bottom. It just so happened to work out the next day. We started shorting from here though. So we were we rinsed and repeated this trade a couple times, but we were still 1, 2, 3, 4. We were 4 days early before the move actually started, you see? but that's because I had an understanding of where they were trading, right? So I didn't have to be perfectly on time. All I needed to know was, all right, they're trading here. I got option flow in my favor. The price action supports a drop. I'm going to go short. And I bought enough time on the contract that, all right, well, I know that they've been pinning it here for 1, 2, 3, 4, 5, 6, 7 days at that point. It's not going to stay up there forever. So by the time I get to day 8, I felt pretty confident in buying that 2-week contract or whatever it is we bought. That should be enough time for this trade to play out. Because SPY's not going to just stay stuck in a range for week after week after week. It's not going to happen. It's just not going to happen. Not in this environment. So after 6-7 days of being stuck in this range, it's about time to make a move. Okay. So anyway, so I bought the 2-week contract, and obviously it worked out twice for us. Let's go to that next question. Okay. If you have questions on that one, feel free to ask. Okay. So how to read? Yep. So I did that. How to enable the volume profile? Yep. How to read the volume chart? Okay. So I just touched on that as well. Okay, can you show us? Yep. All right, did that. Expiration on time on trades. How I decide on the length of time to initiate the trade. Okay, so what I use, what I use to decide in terms of time of trade, okay, is I use what's called the average true range. They should have that on here too. Yeah, they have it. Okay, so you can use an average true range. So what the average true range does, it takes a measurement. I'm talking to you, Equiano, on your question. It takes a measurement of the current volatility in the market. Okay, so let's throw that on there. Okay. Let's see. Let's get this thing set up right. So we'll put it lower. Okay. 1 second. Let's add this selected, apply. I have this on my other chart, so I'm just setting it up for you guys. Okay. All right, there we go. So you can use what's called an average true range. Okay. So I just put that down here. And what this does is it takes a measurement of the average range that's to be expected across a certain time period. So right now I have it set to the hourly, but let's say I'm looking for this impulsive move like I just talked about. Like, all right, I'm looking for this break, right? So what I want to do then in that situation is I'll take it and I'll go to a weekly chart, right? So let's go to a weekly, and I'm just giving you a rough idea here. Okay, so let's go 6 month, 1 week, right? All right. Let's look at that. Okay, so right now, let's see. I use this differently on my my setup, my other chart. So I might have to adjust these parameters look like on the ATR. Yeah, because I know we're not moving that much per week right now. 1 second, let me just make sure. Let me just open this other one up here. Give me 1 second. I just want to make sure that it's accurate, or if I need to adjust. Let's go by the week. I need to adjust the parameters most likely. Oh no, this is accurate. Okay. All right, never mind. These are good. Okay. So yeah, so you'll add the ATR with the under the studies, the same way you added the volume profile. So you'll just click the studies button, you'll type ATR in the search box, and then you'll just add it to it, and it'll put it in the right spot, and then you'll have it show up down here. Okay, and so what that does is that gives you a range of volatility, right? So what you're looking at here is like you have this number here in the corner, right? And what it's telling you is okay, your expected range for the week, the average range based on the current volatility in the market is like just under 15 points, right? It's like, or just over 15 points currently. So like I wouldn't expect, like if I'm trading up here at 560, right? I wouldn't want to have a target that's like, say, I don't know, let's say if my average range is 15 for the week, right? I'm not going to pick a target that's like 525, right? Because that's double the average range. You follow me? If the average range is 15, I'm not going to pick a target that's like 525 because it's outside of the current volatility range. You follow me? Okay? So I'm going to pick something that's within the range. So like for us, when we picked when I picked the target for the group, I was like, okay, we're trading up here at 560, between say 560 and 563. That's where we're going to take our short. And I said to the group, I was like, okay, well, I like this range. I want to target, or I like what's happening up here. I'm going to set this as a target. And I was looking at this. Let me go widen this up. I was looking at this gap here. And I was like, okay, if it gets down to this gap, which was at 544, right? We had 2 weeks on it, 2 weeks to let it play out. That's a valid target, right? Because if the ATR is 15 and I'm buying 2 weeks, well, I bought double. Think about it. I bought double the time it would take for the average distance, if you will, the average distance per week. You guys follow me there? So that's how you would pick an expiration or expiration and target, is you want to give yourself enough time that the current volatility would allow that target to be reached in that time frame. So we had 15 for the week, so I bought 2 weeks to give it enough, because I'm like, if it doesn't work in 2 weeks, it's probably not gonna work, right? Because that's double the amount of time. Okay, so that's how I pick expiration and target, or that's one way I should say. A lot of times I'm typically targeting like inefficiencies in the market. That's me personally, but just I'm giving you like a general guideline of how to, target, how to have take profit targets, and that would be using that. You can use that tool as a general guideline, right? But ultimately, what I really want you guys to be focusing on is price inefficiencies. So like for me, I was targeting this gap here. Let's highlight that, right? Let's make this a little bit better. Ugh. I want this to be better. Anyways, I was targeting this price inefficiency here in this gap. I was like, I want to see that gap get filled, right? In the same way that I was targeting here when we took the last swing, we had this gap up here, right? So I wanted to target this price inefficiency from where this gap to where this market opened as a take profit target. That's really what I want you guys to be focusing on. But in terms of like swing trading and having take profit targets for where you want to be looking is you want to at least use, at a minimum, use that ATR, so that way you're not aiming too far and you're not aiming too close, right? Because all right, if I'm going to buy 2 weeks of time, I don't want to aim for like a 5-point target. I should be aiming for maybe a 10-point at least, or ideally a price inefficiency, right? Where a gap to fill, or another BFI origin that's going the other way, etc. I want to aim where, as always, I want to aim where the liquidity is. Where is the liquidity on the chart? That's where I want to take the profit. Okay, that's where I want to take the profit and maybe inverse the position. So I hear you guys typing. Let me scroll down a little bit. Are your upper regions of the short stop loss area out of the money? What are you referring to? I'm talking to you. So I'm talking. You got the next question up. Are your upper regions of the short? Yeah, I'm just. Oh, are you asking me where my stop is? Is that are you asking me where my stop is, or to summarize here, just to have an understanding? Okay, all right. Where do I place a stop? That's the question, right? How would I place a stop in this situation? Okay, all right. So I use what's called a structural stop. Okay, I use a structural stop. And so what that means for me is I need to see something happen on the chart in order for me to say, okay, you know what, this trade is just it's not doing the thing that I want. Okay. Now, here's the other part to that. Because of the way that I trade, it's all like my initial entry is a stop in itself because I don't enter all at once. Okay? And that's the difference between a regular trader, like an equity trader, or even just it actually doesn't even matter. Your standard retail trader. Hold on one second. Let me just turn this off. It's making noise. Okay. So the difference between myself and 99.9% of traders you're ever going to meet is I average up my winners. Okay? I average up my winners. And because I average up my winners, my initial entry, like let's say, okay, like I started this trade here, right? When I get into the trade, I'm only a third in. I'm 30%, right? So let's just say in this situation, right? Let's just say it's $1,000. Let's use a nice round number. All right, it's better, in my opinion, it's better for me and everyone involved with me to put a 30% size in and see where the market's going to go. And then if the trade is favorable, add to the trade. Versus putting $1,000 in on the very first signal, right? Where we got a signal here at the top. We had a signal and I said, okay, let's enter here. Versus putting $1,000 in here, right? And then risking the potential of a sweep to the upside, another sweep, 4 days of theta, and then the move occurs. If you put in $1,000 here and your stop is say 30%, $300, right? And it burns 4 days or 5 days or 6 days of theta and does a liquidity sweep like this, you will get stopped out. You will get stopped out, like by default, guaranteed. You will be down 30% or more. That is why I don't enter that way. Because if I enter with 30%, right, that position, there's no difference between putting $300 in with zero stop and putting $1,000 in with a 30% stop, right? The money is the same. It's the same risk. There's literally no difference in terms of dollars. But the difference is in that if you put the $300 in with no stop and use a structural stop, because then you can find out. Because they may manipulate you for a few days before they make this 20-point move. You see? So I don't use dollar stops in that fashion. I use structural stops. And a structural stop for me in this case would have been a break, hold, and close above this line at 564. So we entered, we bought in here, we cashed out, we sold it, we added and sold it the next day, and then we didn't do anything here on the next day, and then we shorted this open, and then we started another swing here. We started another swing at 559. But you see, look what they did. Look what they did here. They rallied this price. If I entered here full size at 5, or here, right? If I entered here full size off this, say 560 mark, I would have got stopped on this. And I would have missed this massive move the next day. So I just entered a partial position. The whole group put a partial position in. And this price rallied like crazy into the close. And I said, just leave it. Just leave it. It's okay. You should only be partial sized. So, because if you're partial sized, it doesn't matter. Your risk is the same. Because that partial position can go to zero. It's nothing. You can withstand that. Even if this price on Monday morning would have gapped up and ran to the moon, you should have no effect to it, or no stress about it, right? Now, if this price break, hold, and close above that level, then that would say to me, oh, you know what? This trade is a failure, and I'm going to cut this partial position. So the thing with me too is I never, ever, ever, under no circumstance, will tell you guys to add to a losing position. You will never, ever hear me say those words. So whenever I have us enter a trade, we start always as what I call a pilot. We start a pilot trade. And if the pilot wins or loses, what it does, whatever, we make decisions based on the structure of the chart, not the dollar amount, because our risk is so small, we can withstand a rally like this. But if you go all in here, and they manipulate you before they do, as they often do, they manipulate you first, you get stopped, you take the loss, oh, then the next day it opens up and it falls through the floor. Oh my God, I would have had 500%, blah, 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 blah. You cry about it, right? That's the point. That's the whole point of the market. So the point is to stop you from, the reason I do it like that is to stop you from getting stopped by using that partial position sizing, okay? And then adding. Now the next day when this opened up and it started doing this, we add, and then we sold here. And we were able to capture that 10-point move. You see? We were able to catch it. So anyway, so that's how I manage my risk. That's probably the easiest way to put it. That's how I manage my risk. I never just click on all at once, because of the nature of the market and the nature of derivatives, more importantly. Okay, so I'm going to go to the next question. I'm going to keep working my way down here. Okay, so buying 2 weeks to be safe or based on the analysis. Yeah, so my general rule of thumb, Equiano, for you guys is minimum 2 weeks. Minimum. That's the minimum. Because ultimately, if the market is volatile or it's calm, you're going to need 2 weeks of time at the minimum. Doesn't matter what swing you're doing. You need 2 weeks, man. You got to. Because really what you're trying to get yourself in a position, you're trying to get yourself in a position where the contract is nicely in the money, you're already at your target, and you cash out, and maybe you still got 3-4 days left on the contract. Because for most of these bigger moves, man, like look at this. We'll keep focusing on this one. Like look at this. We need to auto zoom. All right, we started the trade here, and then we finally closed it down, the big one down here, right? But look how long that move took. It took what? From where we entered, 1, 2, 3, 4, 5, 6, 7 days. So you have 2-week contract. You only have a few days. You have 3 days left on the contract. You see, before you have the final closeout, right? Because our price inefficiency hit here at 544. So, but it took 7 days to get there. And most of these big moves, if you want to make real money, that's what it takes, man. It takes, 5, 6, 7, 8, 9, 10 days. So I always say minimum 2. And it also depends as well. Like I said, you can use this as a gauge. You can use the ATR as a gauge, but also the type of ticker that you're trading. So like if I'm trading SPY, okay, maybe I'm looking for a 10-point move. It's well within inside the ATR. I should also mention typically my targets are within the ATR range. Okay, they're within it. So in this case, I was just targeting a price inefficiency. And that's why we also closed the trade when it made the first move, and then we reloaded it again here. So I bought it here, closed it here, bought it back again here, and then closed it one more time, and then we bought it one more time and closed it there. Did the final. So we hopped in and out 3 times. But, we could have just stayed in one, right, from start to finish, but we ended up making more money by doing it that way. Because that's also because the guys were just, they were under my guidance, right? They're under my guidance. So I gave them, I was able to set them up in that way where we could, we were essentially, we rinsed and repeated the trade 3 times, during the whole swing, right? And we caught some other intraday stuff as well. So how do I know if option flow is in my favor? So I have this service. That gives us the option flow data. I recommend to everybody in the group to have it. I have a discount code. I'll paste it in the chat for you as well. So you have it if you choose to use it. It's very, very effective. It saves you a lot of time from reading. I used to read individual option orders, and that just, it's really, it takes a lot of time. This service is great. It literally just takes all the option flow data and it plots it on a chart against the underlying, which is very, very, very helpful and very easy to read. So I'll just paste a quick example of that in the chat so you can get an idea of exactly what I'm talking about. No, just give me 1 second. I'm just opening it up. Here, this will actually be a great one. Here, you can look at multiple companies. So here, you can just take a look, and this will show you essentially the green line is the calls, the red line is the amount of puts, and this is by the millions, and the white line is the underlying price of the stock. So that's what I use to look at the flow data. So I do look at individual orders too, but just at a quick glance, that's what I use because it's very, very easy, super simplified. Any donkey can read it. Why does your ATR look different than mine? It's because you're on a different time frame. So when you change your time frame, so like right now I'm on the 1 hour, so this is showing the average true range per hour. So like the average range on SPY right now is like $1.8 in an hour, right? But if I change that to 4 hours, right? My current average true range is like what is that? It's like $2.5 in 4 hours. If I change it to a weekly, right? My current weekly range is 15.3, right? So it depends on the time frame that you're on. That'll adjust your ATR. And what I would recommend is that if you're looking to swing, which is what I want everyone to do, that's going to be the most effective. As I always say, swing trading that's for beginner, intermediate, and professional. That's where the big money is, and it's the easiest thing to do, or the easiest of all the methodology. It's what the BF5 method focuses on. It's for the guy who also has another job and doesn't want to sit at the desk all day. So you should be analyzing your range on the weekly chart, and that'll give you a general outline of what you want to look at in terms of targets. And then you're going to target. You have your ATR, and then on top of that, you want to be targeting liquidity. So buy side, sell side liquidity, and that's something we're going to get more in depth on. So ideally, your profit targets are going to be within that ATR range. Me personally, I typically like to buy double the time. If I got a $15, as I just explained in the last setup, if I got a $15 range per week, okay, I'm going to buy 2 weeks to let that trade play out, right? Another example, this trade we did earlier in the quarter on CAT, right? The average range is relatively low. It's like $18. It was $18 a week. And when we did the trade, I was targeting really high. I was targeting up here in the 360s, and we were down in the 325s. So I bought a month. So again, same thing. It was double the average range of what's expected in terms of volatility. You see what I did there? So I got 18. Well, at the time it was only At the time it was still about $18 in terms of average. I guess it was like 16 and a half. But I was targeting something that was 40 points away, or 30, 35 points away. So I bought a whole month. I was like, all right, if this doesn't work in a whole month, then it's probably not going to work. So just as to give you an example, but ultimately I was still targeting that price inefficiency, right? I was targeting this here. I was targeting this BFI origin for a retest to sell, right? So I was like, okay, above 360, we cash out, right? That's what we were looking for. So, okay. All right, next question. Do you use TradingView instead of Thinkorswim for chart action and Thinkers? So I use TradingView just for you guys. My whole subscription for TradingView is just so you guys can see my levels, you can see my orders, you can see my my texts that I write out to you guys on each chart if I have a message or something like that, and also you can access my levels 24 hours a day. So my whole subscription for TradingView is literally just for you guys, and it also helps me too, in a sense of you're not constantly asking me, hey, what's your level, what's your zone for this ticker or that ticker. You don't need to ask. You just go to TradingView, click the ticker. You already know what I'm looking at because the zones are going to be there. So, but I do all my trading obviously on Thinkorswim. So that answers that. Okay, wouldn't that be 20, 544, 564? I had a question about shades also. Is the shaded region of your chart market close? Okay, I think I answered that question, Equiano, on yes, you're right. It was 20, which was outside of the average true range, but I reloaded the trade twice. So that's why it became valid, if you will. Because I added, or I repositioned after it started moving, right? And I was targeting that lower price inefficiency in anticipation of a continuation. So yes, it was outside, but that's why I closed the trade and I reopened it and bought more time. Because I figured that gap was most likely going to fill. This one here down at the 544 mark. I should probably go like maybe 30-day just to display that. That should probably cover it. Yeah, so right there. Yeah, so I was looking at that. I was looking at that price inefficiency from this gap where it was left over. And that's what I was targeting. If you saw my Twitter post from like a few weeks back, you'll see I had a short from here, and my target was literally right at that line right there, right here. I was like, I want to close this gap and see. I want to see what kind of orders there and what kind of toys they came to play with. Okay, you had a question about the shaded section. Yeah, so the shaded section, the lighter gray here, that's the after hours. So if you don't have that on your chart, what you need to do is, yeah, so you're probably talking about this, right? Talking about this light gray section versus the black. Is that correct? I'm assuming that's what you're talking about. Yeah. So in this light gray section, you'll just go to this little cogwheel up here, and then I'm pretty sure that's where it's at. It should be in this little cog wheel. Mine's already set up, so I'm just making sure that that's where it's at. Pretty sure it's in that little cog wheel. Show expiration, price axis. I think it's under the general. Let me see. I'm trying to find the what it is it's after hours trading, so or extended hours. I'm just trying to find out where exactly it is. Show corporate. Oh yeah, there it is. Okay, so you'll click this cogwheel here at the top where it says chart settings. That'll open up a little pop-up, okay? And then that pop-up, it'll have a bunch of things under the chart settings. You'll go to equities, and then in the bottom left corner, it'll say highlight extended hours or show extended hours trading session, and then highlight extended hours. It'll look like this. And if you click those two check boxes in the bottom left corner, it'll show the after hours and pre-market trading session. Okay? Good question. Yeah, because you definitely need that. Correct. Yes. The dark section is 6 to 1. And then after hours would be the after hours trading and then the pre-market. Okay? All right. Keep working down these questions. You guys got good questions. I like that. Okay. Yeah. Yes. Okay. So going back to, all right. So you're going back to SPY. Okay. So you're asking me about this short that I entered here. Talking to you, Tal. So you bled when it rallied since you don't have a stop loss. Yep. Yeah. I don't have a price. I don't have a dollar stop loss. I have a structural stop loss. Yep. Yeah, so my initial partial entry was down. I don't remember exactly how much because I don't really look at it. I'm just looking at the chart. So yeah, it was down for I don't know, maybe like 2 hours or something like that, whatever it was. Yeah, 2 hours. Yeah, so it was down for 2 hours, and then the next day, next Monday, it came right back to life, and then I started adding to it as it started breaking this low. When is the option? Which is no stop loss to guard against a rally. Right. Yeah, I didn't put a stop limit in, right? Because okay, so again, going back to our discussion about risk management. So when I entered here, when I took this next position, it was in one of these dojis, like somewhere around here. Because I said to the group, I said, you know what? I was like, this chart overall is gonna break down. That was my call. I was like, this structure is gonna break down. So, and I've seen enough data for enough time and enough signals that I want to take a partial position to get the swing started. Okay. I should also say, keep in mind, we had also just cashed out like a 500% trade that morning. So like just for a reference here. So we're entering another 2-week swing, right? With house money. We have already cashed out multiple plays in that week beforehand. And then we're putting in just a partial entry. Even that morning, we had already cashed out a big play off of this downside move, right? So just so you know, just to keep that in mind here. But at that point, yeah, I was like, all right, I've seen enough, and I've also made enough that I think that this chart is ultimately going to break down. I think this base level here, this is going to break, and we're going to close that inefficiency. So I'm going to start the swing, right? So yeah, I didn't put I didn't put a limit, like a stop limit order in, because again, I was only partially positioned. I'm only 30% in. I mean, this trade, this thing could run up here 5-6 points, right? And we'll just go back to our $1,000 sizing. If I'm 300 bucks in and this chart breaks structurally, let's say it closes up above 564. Let's say it goes to 566, right? It closes at 566. In the position sizing that I just explained to you, you might be down like 150 bucks, right? If you can't withstand that drawdown, like taking a paper cut, trading as a whole is just not. It's just you have to accept that sometimes you're going to be wrong. But the way I like to be wrong is I like to be wrong small. So, and that's why I don't average down losers, right? So I'll take a pilot. I'll wait and see. I know my hit ratio. My hit ratio is like 75% minimum. So if I know that and I put a partial position in and it doesn't work and I take a paper cut, that's fine, because guess what? When I am right, let's just say this trade didn't work out. When I am right, I'm going to end up getting a 4, 5, 6, 700% win with a full size. You see what I'm saying? So I might take, let's say I'm using 1% size, right? Let's just do like quick math here. Let's say 1% is my total size, but I'm entering with partial. So my partial is going to be 0.30%, right? If I take a 50% drawdown on that, that's minus 0.15%, right? That's just simple math. I can do that. Like, look how many times I can do that. How many times I can take a 0.15 negative, right, before I lose an entire position, right? I don't have a calculator in front of me, but I can do that, it's like 6 times, right? Is that right? Almost 7 times, roughly, right? I can do that. I can be wrong 7 times and be right once, and I break even. You see what I'm saying? I can do that over and over and over again as long as I'm managing my risk. No. This is not about cash flow. No. This is math here. This has nothing to do with cash flow. This is simple math, okay? I can be wrong. I can take 7 pilot, right? Let me just make sure I'm doing that math correctly. 100 divided by 15. All right, 6.6. All right, let's just round it down for talking's sake, okay? I can be wrong 6 times. I can have 6 pilot entries be completely wrong, okay? And I lose, let's say, 50% on those pilot entries, okay? I lose 50% on those pilot entries. And I'm down 1 whole position size. If I know that my win rate is 70%, okay, I'm never going to be down 6 times in a row. It's just never going to happen. Okay? So if I'm doing it in that manner, I only have to be right 1 time with a full size just to break even. Even if I was wrong 6 times in a row. Okay? So that's how I manage that risk, if you will. That's how I do that. Let me go back to these questions. Okay. Yes, but how do you place the actual option call put trade with that? How do I put a trade on? Wait, let me just continue. I see you had some other questions. Is how far you have to be out of the money, wrong side of the trade before it's bad, before it turns back into your direction, and how do you place that option trade technically? Okay, so those are 2 separate questions. All right, so let me answer them one at a time. All right, so for me, it's a structural stop. So if I'm entering here, like if this is my structure, right? I have this range. I have a range from here, from 555 to 564. Okay. For me, in this particular situation, it has to break structurally. So that means it has to break this order block up above. It's got to close above it, Otherwise, I'm going to stay in the trade. That's it. It's that simple. Let's say down here, right? Let's say I was trading in this range. Let's here another. This is the same. It's the same idea, just different time period. All right, here's my range. I got 540 and I got 548. Or let's round it up to 549. Okay, I got 540 down here and I got 549 up here. All right, now we took a short here. Same thing. We took a short at like 545, something like that. Okay, took a short at 545. We caught a couple other shorts intraday. This one, this one, this one. All right. Caught a couple shorts intraday, and then finally, when we got the crescendo, we took some zeros down with it, added to the swing, and then closed it out at 540. Okay. This trade never closed above this order block up here. It just never did. So I stayed in this pilot. So that I held that pilot for the week, one day, 2 day, and then in the third day I got what I wanted, and I added to it and then closed it down. I closed it out. But it never closed above. If it did, if this price were to have pushed and closed above, I would have probably been down negative 50% on my pilot entry. So I would have been down, if you're using the standard 1% size, you would be down roughly negative 0.15% on your account. Okay? So that's how bad it, or how far it has to move against me in order for me to stop out. That's the simple answer is the structure has to break. The structure of the current price action has to break. And what that means is ultimately is a range is going to break. It's going to be a range break. It's going to be a range break, hold, and close. But you see this here as well, this big order. It was never able to push back past that. And they kept dumping it over and over again. So I was like, you know what? It's probably going to retest this again. Price inefficiency. I was looking for it to close this gap. So in my mind, anything above that gap is a deal because it's probably going to come back and close it. That's how I was thinking about it in terms of probability. But I was still, even though I had that in mind, I still managed my risk, and I only took one entry, right? And I just waited. Just waited until it finally gave me the thing I wanted. And then once it did, we were waiting for this catalyst here on that Friday. And I was like, okay, well, they're probably going to dump this catalyst. And when they do, we'll add and then size up. And then we'll close it out once it closes the inefficiency. We literally closed the trade here at 540. So, yeah, ultimately, it's a structural loss, a structural break. Structural loss is 30% per entry or day. And then after that, I'm going to talk about how to execute an actual option trade. 30% per. So it's okay. Let me break this down again. Coming to you, Equiano. It's when I take an entry, okay. If I took my entry, I'd divide it up by at least 3 minimum. I always like to take at least 3, sometimes 4. So it'll be either 25% size or a 30% size, right? But that's 25 or 30% size of the total dollar amount of what I'm going to use. So let's say if it's $1,000 size, my first entry on Signal is going to be, let's say if I'm using 4 entries, I'm going to use 25%. So that's going to be 250, right? Or if it's 30%, I'm going to use 300. Me personally, I typically do 30% because I want the partial to be meaningful. So I just stick to 30%. So that's 300 per every 1,000, right? So, but if we're just using our $1,000 number for simple math here, it'd be $300. And like I said, you buy enough time on the trade so that way, if it does break against you structurally, the loss isn't massive, right? It's not a massive loss. Okay. How far you got to be out of the money before it turns back? Okay, I think I already answered that question. And then we're going to talk about this risk management, and then we're going to talk about how to actually place an order. But you do say you take multiple entries. Yep. So I'm curious. I obviously won't be taking. Well, you will be taking multiple entries as you grow an account, right? It's hard to do with a small account. Very difficult. So for small accounts, right, for a smaller account, what I say to them, or even not even necessarily a small account, but even someone that's just on the little bit timid side of risk, right? Let's say you got 10 grand. Let's just say you got 10 grand, but the contracts are, I don't know, they're $300. Let's just say they're $300, right? So you can't even use a 1% size, right? You can't even use a 1% size because your initial entry is already more than your percentage of your account, right? At $300, right? So what you would do in that situation is you would either do two things. One, you either just don't trade that ticker at all, right? Because the contracts are just too expensive. And you move to another ticker where you can buy cheaper contracts that are close to the money for less. So that way you can scale into it. There are tickers that are like that. Apple's one of them. Exxon is a great one. I love Exxon, especially. Exxon's great for any size account, doesn't matter. But you can buy Exxon contracts for like $1 and change for 2 weeks out. Exxon's good. Baba can be good as long as the VIX isn't too high. What else? What other was another good one? Google can be good. Those contracts can be on the cheaper side. Just thinking of other ones that have like cheaper contracts. Yeah, there's just a couple examples right there. Micron, that's a good one. Micron can be good. Contracts are a little bit on the cheaper side. Disney, that's another one. Cheaper contracts. You can, so you could scale it a little bit. So that way, maybe you're not taking two, or you're not taking 3 entries, right? But if the contracts say, I don't know, maybe the contract's $80 on an Exxon contract. Okay, by the time it starts working in your favor, now it's maybe 100 or $1.20. Okay, maybe you can take 2 entries, right? So maybe your first entry is a half size and the second entry is a full size, right? And so that you can play it that way and manage your risk like that, right? So that's a way that you can do that. Yes, yeah, definitely. Yeah, 7 times wrong on the same option, definitely not. 7 times wrong on separate trades, yeah, for sure. Yeah, we're not taking multiple entries on a loser. Never. Never, never, never. Never that. Yeah, we would never, ever, ever do that. Yeah, never, never, never. Forbidden. We cut losers. And we cut losers and we just look to reposition. Okay. All right, we'll go down a little more. I think I missed one question somewhere. Okay, let me see. I understand with an option you have to have 2 weeks to a month or even more for it to go in your direction. Yep. So that short you did, there was a fake out rally right after you entered. Yep. That fake out rally wasn't a problem because you were confident in your position. Yes. And your option is not like a futures trade that you will get correct. Yes, it's not like a futures trade. You will not get liquidated. Yeah, there's no margin involved. Because options are already leveraged. Okay, so futures are leveraged, right? They're leveraged. They're a leveraged asset, right? You can't put margin on an option. You can't trade options with margin, right? Because options are already leveraged by default. So you can't use leverage. You can't use leverage to buy a leveraged asset. that doesn't work because it's like double leverage. So yeah. I see. Got you. Okay, now confusion gone. Yeah. Yeah, that's why I'm not worried about the stop. Yeah, that's why. Yeah. So when you enter the option, let's say, okay, we'll stick to this same $300 size, right? And or $300 pilot and $1,000 total size. When I enter with the $300, my maximum loss is only $300. If I let it go to zero, I can't lose ever more than that. It's you cannot. So it's just that number. Yeah. So your max loss is capped on your entry. You can never lose more. Okay. I think that probably cleared everything up, most likely. Um, yeah, I mean, yeah, you could think of it that way. Yeah, just yeah. I mean, ultimately, yeah, you're just your loss is fixed. Your loss is fixed by your whatever your entry is. Easy way to think of it. Whatever you enter in, whatever you enter with, you can't lose more. It's you are at your max. So it can never go more than that. So if you put in 1,000, your maximum loss can only be 1,000. Put in 500, max loss only 500. Okay. Good question. Oh, how you cut your loot. I want to wait. I want to just finish this one to make sure before I move to the next one. I'm coming to you next about the price and efficiency. I want to make sure that I was worried about how you cut your loses because in options you want it to go a certain way. Well, that's what I told you. Yeah. So I'll start with a pilot, wherever that entry is. Right. I'll start with a pilot, and then if I get a structural break, then I'll cut it. That's it. It's that simple. That's it. Yeah. 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 Once I have an idea, so for me it's idea, yeah, idea, signal, pilot. That's my order of, So or I should say idea structure, right? I got to have an idea. I got to have the right structure on the chart, right? And then I got to get a signal. I got those three things, then I take the pilot, right? Once I take the pilot, I wait to see if the structure is broken. I close it. But if it's supported and it starts giving me more signals that the trade is working, I add to it. For reference, in the last of all the swing trades that we've done in the last, say, 90 days, the last trade that we had where we took an L on, like an actual L, where we were already full sized, it was, my goodness, I gotta go back in time here. That was here. Yeah, it was right here. So that was in June. I was like, yeah, so that was, I guess, more than 90 days ago. That was here. That was the last time I took an actual L and I was already full sized. Right idea. I was a little bit early though. Went long here. It started working, so I added to it, and then it flipped on me. Should have hit it again down there, but it's okay. Right idea. I was a little bit early, but this was the last time, just for reference, and we've done dozens of trades since then. So yeah, that was the last time I took an actual L with size. Like I was fully in, and it turned on me. That was June. What was that? It was June. What's the date here? June 12th. Yeah. So okay. So exactly a month, or exactly 90 days ago. I can't even remember the last time we took a full size L before that. Like a full, like we were fully in and it turned, because like by time I'm averaging up in the trade, that means I've gotten signals that it's working. You know what I mean? like the trade's working, so I'm adding to it. So I'm not saying I'm perfect, but that was my last one. So that, and then we've done, I don't even know how many trades since then. Or it didn't continue to a point where we couldn't have, gotten out of it, etc., or something like that. All right, let's go to this discussion of price inefficiency. So if you came in at 108 and it goes up to 120, but it's very volatile in between your structure. In this particular one, it was a break of this low here of like this is like 111. Yeah, 111. We started the trade like right there, like right at this. We started the trade here. It was literally right in these wicks. I remember it. I remember the trade. And then it started working, started trending, and I was like, okay, add, and then it came back, and then we were at break even, and I was like, and then it failed. So yeah. But yeah, I mean, ultimately, actually, we did have enough time that we probably could have held through this. The right idea, I was just a little early. So I probably should have just taken the break even and then waited for it to structure again. In that particular one, I was using quite a bit of size, so like I'm trying to remember. I'm pretty sure this was the one where I was using more size, and so I remember this. We either took a 50 or we took a full L. I can't remember exactly. I'll have to go back and look at my notes. Yeah. But it did the thing. It definitely did it. I was just a little early. Yeah, I may have even sized up a little too quickly. I probably could have piloted and waited a little bit, but yeah, it is what it is. Some pretty rare, but sometimes that's how it goes. So, all right, I want to get back to this. I don't want to miss questions. Let's talk about price inefficiency. It's a good one. So what I'm talking about here is, let's go to, this will make it more clear for you. All right. So what I'm talking about is, when I'm talking to price inefficiency, I'm talking about traders that are stuck in a position somewhere and they're going to want to get out of it. Okay. So this chart will make it easier to see because of all the gaps that are on it. So let's talk about this example that we've been drilling on, this SPY example. So you see how this price gapped from here, it like closed here and it opened here, right? So what exists in that space right there, it's what I would call price inefficiency. Within that space, anyone who's short, they're trapped now. They're stuck. They're stuck in that position, okay? And anyone who's long, they're happy. They're like, "Ooh, yeah, great," right? But when price comes back into that range, what's going to happen is the price is going to it's going to trigger a pool of liquidity. And what's going to happen is you're going to have shorts that'll cover, you'll have long stepping in, you'll have anyone who went long from here over the last 2 days. When that price enters and breaks that line, they're going to stop out. So people that are long from here over the last 2 days, they're going to stop. These guys that are long from here, they may go break even. And anyone who's been trapped short, they're going to cover. So what's happening in there is a bunch of liquidity. And that's what you want. That's where you want to trade. That's why we closed our shorts here. That's why we did that. We literally closed our last shorts in this wick here, like at the bottom of this wick. As it closed that gap right there, I was like, guys, trim. Because the chances, now we don't know if it's going to rally like crazy, right? But the chances of this thing at minimum popping are very high. But now if this structure would have broke, like if this would have broke and closed underneath this, then I would have actually added back into the short. But because it didn't, I just decided to close out here and then just wait and see what's going to happen. And then the second half of the day, I didn't do anything. I just kind of just chilled out and waited to see what it was going to do. So again, when I was taking this initial short from here, right, and I was targeting this 544 level, which is right here, I was looking at this price inefficiency or this gap that was left behind over here. See this? So it's the same idea. So I was like, all right, when it closes this price here, which is right there, right? I want to start trimming my position. So we just trim, and then we took our final exit down here, right? We closed it out in full once it started basing, because this is one of our structures, drop, base, right? And then you don't know what it's going to do next. You got to wait and see. So if it breaks down, okay, we'll go short further. But if it pops up, all right, well, we're going to see about that inefficiency getting closed down later on, okay? But that's ultimately what I'm looking for. So when I set my targets, I'm always looking for these gaps. Always mind the gap, mind the gap, mind the gap. Because I'm going to tell you right now, not always, but most gaps on SPY SPX, they will get closed. And not only will they get closed, but they will get closed typically within 72 hours. This is a prime example of that. 1 day, 2 day, 3rd day, closed. Okay? Here's another one. First day, opened up, got another inefficiency there, ended up closing down the next day. Another gap, closed the same day. Another gap here. You have another inefficiency, but see what happens every time it closes one of these gaps? Look what happens. See how it closed it, and then it popped immediately. You see? It closed this one, flattened out, popped. Closed this one, flattened out, popped again. You see what I'm saying? So these inefficiencies, when they're on the chart like that, so when this one closed down, I was like, oh, it's time to start trimming this thing out. Because the chances of a pool of liquidity being triggered within that gap are very, very, very high. So I need to trim. And you can see actually here, look. I gotta get what? I need to go to 20 day, maybe 15 day, 15 day, 15 minute. Look what happened as soon as it entered that price. See that wick right there? See how it popped up like that? That's a big move, man. That's billions of dollars right there. But as soon as it started entering that inefficiency, you see, it started triggering those orders to start fire off. And that's why that price went flat like that. But that was a first signal right there. It's like, hey, I'm here. Those orders are sitting there. We had already trimmed, and we were fully out in this base. But that's why those gaps are so important. Those price inefficiencies are so key. You know, and that's just one great example of it. So I'm always watching these gaps for targets all the time. Okay. All right. I'm going to move along to the next question back to you, Equiano. All right. This clears up my structural loss. So position is 30% for the entry, or are you entering with 3? All right. Yeah. So it's okay. I see you're having. All right. So it would be, sorry, not 30% of the account. 30% of the position size, right? So it's a little bit harder on a 10K account, but let's say, all right, let's say you're, because it's a smaller account, it's harder to do it with because of the cost of the contracts. So let's just let's just bump it up to a larger round number, right? Let's just say 100 grand, just to make it easy for me for math. So like 1% of 100 grand's $1,000, right? So if you got $1,000. And your position size would be 1%, right? Then 30% of that 1% would be $300, right? And that would be like a starter position, just as like an idea here, how to, like, just for math purposes to make it easy for me. You got me? So you're trying to enter with 30% of whatever the total capital is that you plan to use, but never 30% of your account. That's way too much. So if we were to like scale this down to like a 10K account, right? Maybe your total entry might be maybe $250, $300, right? Maybe you're gonna buy Walmart contracts. That's another good one. Maybe you're gonna buy Walmart contracts, right? You're gonna use $300. Your first entry might be like $50. Your second entry might be like $75, right? So now you got $125. Maybe your third entry is like, I don't know, $150. Now you're at full sized. You got me? but your initial entry may only be, I don't know, $100, right? Of that $300 total size that you plan to use on your 10K account. Does that clear it up? Okay, cool. Perfect. All right, great. Okay, I'm just making sure I'm not missing any questions. I know I still got to go over how to execute an option order. Okay. Okay. All right, so I'm going to do this last question from Utah, and then I'm going to go to how to execute an actual order. All right. So it went up on an upswing, long-term trend on that. And during the ensuing trend, what kind of strike would you take to go through all the volatility to 120? So here's the thing with options. They're really interesting in the way that they work. But let's go back to this same example. Let's go maybe 60 days, 30 days. Yeah, let's just look at the daily. That's easy. Okay, we'll go back to one second. I'm just setting it up. You know what? This will probably be an easier way to observe this. Let's go weekly. All right. So here's that same trade, right? That trade is from here, where we opened it up in this wick. We opened it up right here in this wick, and then it ended up getting stopped out, and then it ended up working, right? Ended up working later on. So easy to look at this, right? In this perspective, when you're swinging, you always want to be examining that weekly chart, right? So like in this scenario, right? You're asking me what strike would I hold to run it all the way back up, right? Run it back up. Well, one, I wouldn't be targeting the 120 level on an initial swing unless I bought enough time to do so, okay? Because notice, look at the range here. Look how much range we have. So we have we're only moving 5 points a week, right? So if I'm down here at 108, and I want to go to 120, right? So that means at a minimum, that's at least 3 weeks. And that's assuming it just runs in a straight line, no pullback like this, right? Because I got to go 5, 10, 15, or, I got to go, 12? I got to go 12. I got to go 12 points, right? So at a minimum, that's 3 weeks. So for one, I wouldn't want to target the 120 level because it's just a little bit far. Like it's just a big target. Just so you know, too, on Exxon, like if you're involved on an Exxon trade on a 2-week swing, even a monthly, and you get anything from 2 to 4 week contract, and you get 5 points in your favor, that's a nice win. That's a really nice win. We've done a few Exxon trades over the last few weeks to the short side, and we did one to the long side. We did a short literally from the tippy top of this candle right here, and ran it down here to this 114 level. Actually, I think that 120 to 114 trade was just shot. It was either just shy or just over 500% on that particular trade. That was like only a 6-point move, And then we ran it back long the other way to the literally up here to one. I think we cashed it like 118 and a half. And that was like another like 250, 300, something like that. So Exxon, your targets, you don't necessarily want to be aiming very far especially for swings. Like if we're on a swing and we're on Exxon and we get like 5 or 6 points move clean in our favor, we're typically, trimming and closing out, just so you know. So, but anyways, in this case, right, where you would want to target would be the origin of this BFI footprint. That would be a more valid target, right? because they bought it here, right? I have a price inefficiency here because it closed here and opened here. So that's a good target for me to look into, get out of this, because chances are when it comes back into that price range, it's probably going to sell again. And the same reason why we took this trade up here, once it pushed up above that short line there, we took that short because it's most likely still sitting a bunch of short orders up there. So anyways, what strike would I take? Personally, I always tell these guys just go at the money, because if you go at the money, the deeper that strike goes in the money, the IV the contract starts expanding exponentially. That's the easiest way to put it. You will make more money, most likely, by buying a 110 contract and just going from, a 109 contract, and just going from 109 to and closing it out at 116, than you will if you bought a 116 and tried to target that on a 2-week, and then you get to the end of the week and it's just barely getting there. That 109 is probably going to go from like 150 to like 500-600 at up here, versus the 116. You're going to be fighting theta the whole way up. So I always recommend to everyone in the group, trade at the money, or at most like 1 or 2 strikes out at the maximum. So if you're entering at 109, you shouldn't be taking anything more than like a 111 max. Because Bob, stop. Because again, you got to keep your range in mind, right? So if my range is only 5 points a week, I'm not going to, if I'm entering at 109, right, and I'm buying a 2-week contract, I'm not going to buy a 114 strike because it's too far out. It's just like, it might hit, but if it doesn't, you're going to get slaughtered. Like you're just gonna have a really hard time holding it. That's probably the better way to put it. You're gonna have a hard time holding it because of the theta decay. Once the contract is in the money, you're not getting hammered with that theta anymore. But when it's out of the money deep like that, that's why it's difficult. It's problematic. That's why I'm going to tell you a little known secret here. That's why most retail traders blow their accounts, because they go for these really deep strikes and they're too far out, and they just get blasted. Yes, exactly. Yes, exactly. For covered calls, you want to do the exact opposite. You want to sell those out of the money strikes because most of them are going to expire worthless, and you're going to collect the premium. That's right. Exactly. And you collect it as income. I've been selling covered calls on BABA for months because everyone's always betting on this massive move. And that massive move is probably going to come eventually, but I'll be there for that as well. The point is that stock has been stuck in a range for years. And so selling the out of the money calls, they just keep getting obliterated over and over and over again. And I just keep adding that premium that I collect. I just keep buying more shares with it, and I keep selling more covered calls, and I just keep doing it over and over and over. Oh, it's great. I love this stock. I love it. I hope it stays in range for another year. I really do. I hope it does. I hope it's just stuck there. I hope it just stays there. Like, look, it's been in this range forever. Like, once it got down here to like 80, it had a little bit of volatility, but I didn't start my position until here. I started that position over here, and it's not going anywhere. It's just sitting there. Yeah, I'm in equity, so I'm a massive equity position. But also, when it does pop, I'll be there for the pop, and I'll buy calls, and I'll also buy those calls too. I won't be selling covered calls for that. You know? Yeah, so I got some like 100 calls that I've cashed that I've sold on. Like they're not. That's not hitting. That's not, yeah, that's not hitting anytime soon. Now I do think that this stock will rally in the future, right? Eventually, like I anticipate this stock to be up massively, but right now, no. Okay, Baba, stop. Okay, so I want to talk about actually executing an order. So there's two things I want to talk about on this. One, how to execute orders. Very, very easy. Super simple, very straightforward. Okay. So here's I just click this option chain here on the side, on the right. It just opens up the chain there on the bottom. Okay. Super easy to execute. We're on the week of the 20th. So like this is for this week. All right, I'll just expand this a little bit. And so here's all our options that we have available, right? And we're trading at 85. So maybe we want to go with the 85 call. Right? So then I'll just click that. Just click that so it'll pop up down here. You have your buy order. You can adjust how many you want. Like this. However many contracts you want to buy. And then how you want to buy it is here, the type of order. So ones that we use predominantly is going to be limit and trust stop. Those are the main two that you're going to be using. So my standard rule of thumb for trailing orders is I like to get in at least 10%. So on a pilot entry. And even when you add to it as well. So like in this case, like the contract is trading. Let's see the spread. The spread on this one's pretty big. So you're at like a what, one. So you got $30, $35 spread. So plus 15, so 145. So in this case, maybe I'll put like a $15 spread like that. So I'll do 10% of whatever the contract value is, right? And then I'll trail in there and let that hit. So then I'll just confirm send, bing, just like that. Now I got an order pending for when the market opens to buy 6 contracts based off of that spread. And that's how you actually buy an actual contract. Very, very simple to do. Okay. If you want to just get in it, if you want to get in immediately, yeah, it's a big spread on this. Yeah. Also, I should say on BABA, like when it gets like to market close, the liquidity gets a little bit dry, so the spreads get wider. That's normal. When the market opens, the spread will tighten up. That's just how BABA is. How to exit? Same thing. So let's say I already bought this, right? It would just be the opposite. You would just click this right here. So in this case, this is buying. I'll just click this right here. Now it's a sell. And then however many you want to sell. I don't know. I want to sell, 3. I want to sell 3. I want to sell them off a, maybe a trailing stop. Maybe same thing. Maybe I want to use like a $15 spread to knock it out. And then I'll click sell like that. Now I'm selling 4 contracts, after they fill, right? And that's how you would exit. And that's with a trailing order. Or if you want to just get out now, like right now, you can do it 2 ways. So you click the contract again. If you want to exit now, like and you're dying to get out of it, you can mark it. I don't recommend market orders, but you can. If the spread is tight, you can mark it out. But my preference is a limit order. So maybe I set a limit. This one, it's like the mid is like 145. So maybe I'm going to throw a limit. Maybe I throw a limit right there at like 145. Right? Maybe I want to get out quicker, so I'm going to be a little bit closer to the bid side. Maybe I'll go like 140 so that somebody will jump on it, right? So I could limit out like that, bing, ready to roll. Okay. Or if you want to trail out, well, I already showed you how to do a trail. Now, if you want to set a stop, let's say you're in it. Let's say you're in this contract at one. Let's say you bought them at one. I don't know. You bought them at 150. You're fully sized, right? Now you want to set a stop, so that way, whatever, you're protecting your capital. So you go stop limit, and maybe I want to do, I don't know. Let's just say 50% drawdown. So I would just set this right here to 0.75 on the limit. And then I want the stop to execute at, say, 0.80. So when this price gets down to 0.80, it's going to activate a 0.75 limit. That's what that means. Okay? So this has to drop to 0.80, and then when it does, it will automatically set a 0.75 limit order to exit. Now, typically, I give a little bit of space between the limit and the stop, so that way it doesn't jump the order, especially if you're in a fast market. Okay? You don't want to put the stop at like 0.76 and then the next bid is 0.72 and to jump your order. Give it a little bit of room, maybe a 0.8, 0.82, so that way when it gets to that and your limit comes in at 0.75, you actually get a fill. Okay? Is there a problem with a quick market exit? There's not really, for the most part, especially for the tickers that we trade. So I really only trade mega caps. Like I don't trade these like little low liquidity stocks, and I don't recommend that you do either. There's really no point to it. Like, I mean, not for options. The only downside with a quick market exit is if there is a large spread in a volatile market. Now, but again, for the stocks that we trade, that's typically never the case except for one ticker. There's one ticker that we trade that if you market order, I would not recommend that you do that. And that would be SPX. And for those in here who have traded this, they know exactly what I'm talking about. Because on SPX, first of all, the spreads are always pretty large. Like there's always like a, 100, it can be as much as $200, $300 spread. But especially if you're trading 0 DTE, that market order can be, oh man, you don't want to do it. Don't do it. That's it. Don't do it. Just don't. Limit out only. And limit in only. Don't market in. Mark on SPX. They look tight right now. The market's closed, sir. Wait until the market opens. It can get... you can be trading at a $1,000 contract, okay? $1,000 contract. 5 seconds later, that contract can be $600. 5 seconds, okay? So if you market, you may get the 600 instead of you may see 1,000 on your screen, but the next bid is coming in at 600. You can't even see it. So if you hit the market, you're going to get the 6 instead of the 1,000. And that may be, depending on what you're trying to do, in or out, right? That can be very, it could be a big problem. Oh, yeah. Apple, Google, that's why I said this only really applies to this one ticker. For you don't have to worry about, you're not going to be trading this anytime soon. You shouldn't even look at this right now. This is not for beginner. This is not even for intermediate. This is advanced only. Advanced and professional only. You really got to be dialed in and know what you're doing when you trade this. For reference, there's only 2 people in here that trade this consistently. One of them's me. Okay? Nobody. This is me and Ali. Nobody else trades this consistently, and you shouldn't. But yeah, Apple, Google, very tight spreads. You don't have to worry about anything that I'm discussing here. In terms of SPX, yeah, these spreads are going to be tight. You see, $300, $295, $5, $10, very tight spreads. And this is even at market close. When the market opens, that spread may even tighten to $2, $3. So, but yeah, Apple, Google for contracts that are at the money or even a little bit out of the money, the spreads are very tight, very, very tight. Even once they go deep in the money, look at this. Even when they're deep in the money like this 235 strike, look, it's still only a $30 spread. So very tight. So yeah, so that's why I say for mega caps is so important, or so much better, sorry, to trade mega caps because the spreads are tight. I mean, is that simple. The spreads are tight. You're never going to get washed in the spread. And you don't want that. You don't want that. Like I'll give you an example of a company that actually is a very big company, but for whatever reason, the option chain is always light. And the spreads on this one are always big. That's just how it is. I don't know. It always has very, very wide spreads. See, look at the difference between like this and Apple. You got like $100 spread on a $500 contract. And this is at market close, but man, I've seen these spreads on LMT. Sometimes they're a few $100. The contract may only be like $700. The ask may be $700. The bid might be $520. And I mean that's just how it trades. There's just not as much volume in the chain, so we don't really trade that one very often. That's a specialty only. We haven't touched that one in here in years. So, but yeah, for the stocks that you're going to be trading, just work with my list. That list has been catered for a reason, and just only work from that list. Don't. I would 10 out of 10. Do not deviate from that because I've already done the legwork for you. It'll just save you the time, and you don't need to. There's so much money in those that there's no reason to go elsewhere. And you got like, I don't know, 20. How many's on there? 25 or so, something like that. It's like 25 tickers or so, but we predominantly only trade like less than, really less than 10 consistently, and every week it's only probably less than 3 every week. Yeah. Ali has a great point there. Yeah, if you're only taking the HPTs, especially starting out, that's where you want to be. But it sounds like that's all you're really gonna want to do anyways. High probability trade, low probability trade. Yeah, there's I think where did Jerome put it? There's a acronym. I think he put it in the education section. Let me see if I can find it here. Jerome, do you have it on hand? The acronym chart. I'm trying to find it. Jerome made a really nice setup that has all the acronyms on there. Maybe he can share it again. He's got it. Otherwise, I gotta look for it. It's in the fact. Okay. Ah, there it is. Yeah. Okay. Yeah. So just put it in the chart in the chat, so you have it. Oh, you have a updated? Okay, yeah. If you could share it, that'd be great. That way they can have it too. Have the updated version. Okay. So you guys, we went over how to execute an order, how to put the volume profile on, how to use it, what it means, how to gauge your targets. We just brushed on that briefly. You know, ultimately, I'm always targeting liquidity. That's really the main goal here. And what else? Yeah, I mean, we talked about quite a bit here. I think that was a pretty good overview. Do you guys have any other questions for me that you want to dig into? You got me here, so we got this all recorded too, and I'll upload this to YouTube afterwards. So you'll have it if you want to go back and review it. Oh, actually, there is one more thing. There's one more thing I want to talk to you about that we did not talk about yet. This one is also important. Very, very important. Okay. You are, we'll just use Apple. Okay. You are trading Apple. All right. You're trading Apple, and I don't know. You want to go long. You want to go long because you want this top to break here at 225. Let's just say. Okay. Now you want to buy an option, and price is now at 222.5. All right. You go to your option chain. You get that popped open. You go to your, okay, perfect. We even got half strikes here. So you go to your 222.5 contract, and you're like, okay, it's trading for like 300 bucks. All right. Now, you can make a decision based on the bid and the ask at that time, but what I like to do is I like to take this contract, right click, okay? You get a little, does this drop down show for you? You guys right here? Can you see this or no? You can? Okay, good. Great. All right. So drop down. You want to go over here, more info. So more info. Scroll down. TOS charts. Okay. You want to go, so more info. Drop down. TOS charts. Go right. Put this. Now this one is highlighted because that's what's showing right now. Throw that one right next to it. Boom. All right. Now, what is this chart here that I just put up? It'll be in the recording though, if you couldn't see it. It'll be in there because I'm just screen recording, so it'll capture it. Okay. Now, what is this that we're looking at here? This is the chart of the option in relation to the underlying. Okay. This is the chart of the option contract that you're interested in relation to the underlying. Now, what you can do, what can you do with this information here? You can see where the contract's been, what it's been trading for, right? And what may be considered cheap, perhaps, or expensive. So you can also get a gauge of how much this contract is moving. Now, I have this on a daily chart, right? So this is this time period here is across what is this? This is from 8/19 to last Friday. Okay, let's just go 5-day, 15-minute. Now you can get a gauge on what's a good price. Maybe it's closed at 300, but maybe tomorrow I want to set my limit order here at 2.6 because that's maybe a better price. I might get a wick down, and that can give you a better feel or an expectation of what you could anticipate the price to be, perhaps, is maybe a good way to look at it. So I like to use the option chart in conjunction with the underlying, so that way I can also get a gauge of where traders are also trading too. Because a lot of times what you'll end up seeing is, if you put a volume profile on this too, on the option chart. Can you guys see the option chart too, by the way? Hopefully it should be showing up for you. Okay. Okay. You can gauge where traders are active on this. And that can a lot of times what you'll end up seeing is the point of control on the option chart will end up being a great entry. Just so you know, when the price is consolidating. So just something for you to keep in mind. But you can at least get a gauge of like, okay, well, this contract's at 3 at the low a day down here, right? But maybe at the high a day, it was trading up here at 4. Okay, maybe I want to buy at 3, sell at 4, right? That's a good deal, you know. Or buy at 3, maybe sell it up here where we had up on these wicks, 4.5. So I like to keep the option chart next to the underlying of whatever I'm trading, especially on SPX, because it can be very, very beneficial to have an idea, an expectation of where that price is going. Okay. What app do you use for figuring out options are in your favor? It's this platform is called TradyTix. I told you I will put a link. I'll put the link for it because I have a promo link that give you a discount on it, and that gives you the information that you're questioning. I just showed you how to do it. How to place an order. Talking to you, I just showed you how to do it. So you just click that option chart like that. Click the contract that you want and the strike, and then you just boom, click. Oh yeah, I mean you're not gonna learn it all in one go. But this is how you do it though. And click buy. How many you want to buy, and then what kind of order you want to use. Yeah, this is a simulated mode right here. Yeah, this is but this is the same as the real thing. The structure is the same. Yeah. Yeah, of course. In my opinion, I would practice at least for, a couple weeks getting used to this platform before you go live, and then, give yourself some time to understand how this all works. That's what this is for. Yeah. And what you can do even right now is you can even trade ES, right? You can actually execute orders, live because it's trading right now. When you open, talking to you, Exponential, when you click your desktop at the bottom, there is an option and it will say live trading, and I think it says paper trading. You just select the simulated trading. You just toggle it before you sign in. That's all you got to do. What's ES? ES is futures trading. That's essentially it's reflective of SPY SPX. It trades around the clock though. Yes, at the money contracts are more expensive. However, when you're wrong less in terms of percentage. But then when you're right, like I told you, when the contract goes in the money and it starts moving in your favor, just to put it simply, the contract expands exponentially. it expands massively, and it also is very safe because you're not getting hit by theta because it's in the money. So the idea is you want to get, yes, exactly, yeah, exactly, bingo. You want to get a contract, you want the price to start running in your favor, and you want it to go in the money. And once it's in the money, then you can sleep good at night. You can sleep good at night, man. When it's out of the money, you don't sleep, man. That's it. You don't sleep. You're like, oh man, I don't know if I should have done this. That's simple, man. That's simple. When it's out of the money, you stress. You're stressed. That's it. Guarantee, I promise. Once you do it a couple times, you will understand why. I'm saving you some headache here. I promise you. Okay. Mhm. Yeah. Yeah, absolutely. To your comment, Jerome. But as you've noticed, like you just said, in the last 2 weeks, right? You said you thought you were disciplined, but you realized that you were not. And there's different levels of discipline and patience, right? But I think also you imposing that discipline on yourself and just strictly following along with my trades and my trades only, that has probably imposed a different level of patience and discipline on you. But it's also very reflective in your profit and loss too. So in a good way. So that's, everybody's journey is different, man. Yeah. How quickly, and the thing is you understood the technical method, I think, very quickly. It's not very complex. It's essentially it's very simple. But cracking that psychology is, oh man. It's as you notice, Jerome, like other traders in here, right? Like they have different pace, but you notice I haven't done anything different. That's why my trades work. They're all the same. They're all the same. There's nothing different about them. It's very, very. It's simple. It's simple but difficult. That's it. But it's simple though. It's only difficult because it's difficult psychologically. That's the difficult part. It's not. Most of the traders, most of the errors are psychological ones, as you know that. You know that just as well as anybody else. They're typically not. They're psychological errors that force you to make technical ones. But now you can trade ES as well, but not with which are another. Yeah, I would. I would say to that quote, that comment, we're gonna we're not gonna be messing with, or you're not gonna be messing with futures just yet. That's a different beast because you have to take into account Asian and London sessions. Here's the cool part, though, something you should realize as well. I trade futures, but I typically only trade the Asian session. If I am gonna trade them, or like before market open, if I'm like trying to catch a move on like a print. Here's the cool thing though. Uh, the Asian and London sessions set the range for the next day. Okay. the New York session typically wipes the range.